Okay, let's talk about a moment that's both incredibly exciting and, let's be honest, maybe a little terrifying.
Starting a business?
Exactly. Or maybe you're already running one and just rethinking your whole setup. You've got the big idea, the strategy, the passion.
And then, bam,
Yeah.
a mountain of decisions.
Right, not least of which is, okay, what legal structure should I actually pick? And it gets clear super fast this isn't just paper shuffling, it's fundamentally about taxes.
Oh, absolutely. Taxes loom large.
So this deep dive, it's all about cutting through that tax maze. We've got this really solid stack of sources you provided, really digging into how you form these entities, and maybe just as importantly, the tax costs if you have to shut things down later.
That's right. And, while everyone first thinks about legal liability like, how do I protect my house?
Yeah.
The material you've shared makes it crystal clear.
Yeah.
It's the tax characteristics. Those are often the real drivers behind picking one entity over another.
Really? More than liability sometimes.
Often, yes. How profits get taxed every single year, how you can use losses, how owners actually get paid, what happens when cash leaves the business. These tax rules, they have massive implications. For your bottom line, for your flexibility down the road, it's huge.
It feels like the tax tail can definitely wag the legal dog here.
Yeah.
And getting that upfront choice right, well, it could save you or cost you a fortune.
No exaggeration.
So our mission here with this deep dive is to take all these detailed insights from your sources and translate them. Make it really clear what the key tax differences are between, say, a sole proprietorship, a partnership, an LLC, an S Corp, a C Corp.
All the main players.
We want you to see why this choice matters so much and maybe figure out which structure might fit your specific situation best based on what these sources are highlighting.
And we'll try to really pack in the core concepts from the material, give you a solid foundation for making this, frankly, critical choice.
Because understanding this stuff up front seems way easier than trying to untangle a mess years later.
Oh, much, much easier. Trust me on that one.
All right, let's jump right in. Let's set the stage. Your sources start by framing this whole decision as a balance, right? Legal protection versus tax treatment.
Exactly. Two sides of the same coin.
So let's start with a quick nod to those legal differences they mentioned, because that's usually where the initial thinking starts, isn't it?
Absolutely. Legally, these entities are quite different. First off, the number of owners. A sole proprietorship, that's one person, by definition.
Also low. Got it.
Partnerships generally need 2 or more people. Corporations, both C and S types, can have lots of shareholders, but S Corp have limits.
Limits.
Yeah, like usually capped at 100 owners, and they have to be specific types of owners, mostly individuals who are U.S. citizens or residents, some types of trusts, not other corporations, for instance.
Okay, owner count. What about just the paperwork, the red tape to legally exist?
Good question. It varies a lot. For a sole proprietorship or a general partnership, pretty minimal, actually.
Right.
Yeah, you can often form one just by, starting to do business together. Though, let me tell you, a written agreement for a partnership, highly recommended.
I bet. Avoids headaches later.
For sure. You might need local licenses, things like that, but usually no big formal state registration, just to be one.
Okay. And the others? LLCs, corporations?
Totally different story.
Yeah.
Forming an LLC, an LLP, or any kind of corporation legally, that demands formal filing with the state.
Ah, so actual paperwork.
Yes. Submitting articles of organization or incorporation.
Yeah.
It's a deliberate, documented step you have to take.
And the big one. The reason most people probably look past being a sole prop or partnership. Liability. Protecting my personal stuff.
Critical point. Absolutely critical. And often the very first reason someone thinks, okay, I need something more formal.
Because
in a sole proprietorship or general partnership, the owners generally have unlimited personal liability.
unlimited. Yikes.
Exactly. Business debts, lawsuits, your house, your savings, potentially at risk. That's a complete non-starter for a lot of people.
Understandably.
Now, limited liability partnerships, LLPs, and limited partnerships, LPs, offer some protection, but it can vary by state and depend on the partner's role.
Okay, so some protection there maybe.
But the structure is really designed for broad limited liability. That's your C&S corporations and your LLCs.
Those are the main shields.
Right. In these, the owner's personal assets are generally shielded from business creditors, barring, fraud or if you personally guaranteed a loan. But generally, your risk is limited to what you invested in the business.
That's a huge difference.
It is. That robust legal shield is why LLCs and corporations are so incredibly popular.
So, okay, liability protection really pushes people towards those more formal structures. What about who's actually running the show day to day? Management.
that differs too. A sole proprietor, they're the boss. Simple.
Makes sense.
In a partnership, usually all the partners are involved in management unless they agree otherwise. Or, if it's a limited partnership with different types of partners.
Right, general versus limited.
Corporations have that formal structure. Board of directors overseeing things, appointing officers who run the day-to-day.
More layers.
Yes, and LLCs. They offer flexibility here. They can be managed directly by the members, kind of like a partnership. Or they can appoint managers, more like a corporation's board.
Lots of choices with LLCs again.
They really are flexible.
And what if an owner wants out, wants to sell their share?
Transferring ownership, generally pretty restricted in partnerships unless the agreement specifically allows it. Often needs the other partner's consent.
Makes sense. You want to know who you're in business with.
Exactly. Corporate stock, generally easier to transfer, although shareholder agreements or S-Corp rules can put limits on that too.
Okay.
And LLCs, similarly, usually have transfer restrictions spelled out in their operating agreement.
Got it. So that's the legal landscape. Owners, formation, liability management, transferability. But like you said, the sources really pivot hard to the tax differences. That's where the real action is for this decision.
That's where things get really complex and, frankly, often have the biggest financial impact. And the first crucial insight from your sources here is that for federal income tax purposes, forget all those legal labels for a second, the IRS really only recognizes 4 main types of business entities.
Only 4? What are they?
The C corporation, the S corporation, the partnership, and the sole proprietorship.
Wait a minute, you didn't say LLC. If I form an LLC, how does the IRS tax it? It's not on the list.
Ah, yes.
Huh?
This is where the famous check-the-box regulations come in. And it's a really powerful bit of flexibility your sources definitely highlight.
Check the box.
An LLC isn't actually a tax entity itself. Think of it like a legal container, a wrapper.
Okay.
And it gets to choose which of those 4 tax costumes it wants to wear.
A tax costume. I like that. Explain.
Okay, think of it this way. If an LLC has 2 or more owners, its default tax costume, the one it gets automatically unless it actively chooses something else, is a partnership.
Default. Partnership for multi-owner LLCs.
Right. If it has only one owner, and that owner is a person, an individual, the default costume is a sole proprietorship. You just report everything on your personal Schedule C form.
Single owner LLC equals sole prop by default.
Got it. And if that single owner is another company, say, a corporation, then the LLC is usually just ignored for tax purposes.
Yeah.
Disregarded entity is the term. Its activity just gets folded into the owner's tax return.
So the legal LLC wrapper gets taxed like a partnership or sole prop by default.
Yes, by default.
Okay.
But here's the really cool part, the flexibility your sources emphasize. An LLC, or really any unincorporated entity like a limited partnership, can elect. It can choose to be taxed as a C corporation instead.
You can just choose to be a C corp for taxes.
Yep. Files a form, checks the box, and if it meets all the S corporation eligibility rules, we talked about owner types, number of owners, etc., it can then make a second election to be taxed as an S corporation.
Whoa. Okay, hold on. So an LLC gives me that limited liability shield, and I can pick my tax treatment. I can choose to be taxed like a sole prop if I'm the only owner, or a partnership, or a C corp, or even an S corp.
That's it, exactly. That flexibility is massive.
No kidding.
It's a key takeaway. The LLC structure legally protects you like a corporation, but you get this incredible tax flexibility. You can pick the tax treatment that best fits your business's financial picture.
Explains why they're so popular.
It really does. Okay, tax costumes, check. Understood.
Let's dive into the specific tax differences now, moving through the business life cycle. Your sources first look at what happens right at the start. Contributing property. Putting assets into the business. Is that taxable?
Great place to start because, yes, it can be a taxable event depending on the entity.
Yeah.
And your sources are clear. Getting assets into the business tax-free.
Yeah.
Generally much easier for partnerships and sole proprietorships.
Easier than for corporations. What's the catch for core? CNS.
For corporations, you run into a specific rule. Internal Revenue Code Section 351. Now, this section can let you transfer property to a corporation in exchange for its stock without recognizing immediate gain or loss.
Okay. Sounds good so far.
But, and it's a big but, you have to meet very specific requirements. The main ones. You have to transfer property, cash counts, equipment, buildings. You generally have to receive only stock back in return. No cash or other property, what they call boot.
Solely for stock. Okay.
And here's the crucial one. The group of people transferring property in that transaction must collectively control at least 80% of the corporation's stock immediately after the exchange.
Okay. The 80% control test, that sounds like the big hurdle.
It really is. It's the gatekeeper.
Mm-hmm.
If you, along with anyone else contributing property at the same time, meet that 80% control threshold right after the transfer, fantastic.
Mm-hmm.
The exchange is non-taxable under 351.
Tax-free entry. Nice.
And your basis in the stock you get. It's essentially your old basis in the property you put in, adjusted for certain things, like if the corporation assumes debt tied to the property. And the corporation, its basis in the asset it receives is also your old basis. It's a carryover basis. Any tax on appreciation is deferred until later.
Okay, so if we hit 80%, it's smooth sailing tax-wise. Basis just carries over. But what if the group contributing property doesn't own 80% right after? Say, I put in appreciated property for 60% of the stock, and an investor puts in cash for the other 40%. Cash isn't property for this test usually.
Good example. In that case, Section 351 is not met by you, the property contributor. The transaction becomes taxable to you.
Taxable how?
You're treated as if you sold that appreciated property to the corporation in exchange for the stock. You'd have to recognize gain on that built-in appreciation immediately.
Ouch. Just for starting the business.
Yep. Your basis in the stock you receive and the corporation's basis in the property it got from you would then be stepped up to reflect the gain you recognized. But yeah, failing that 80% test, it can trigger a really unwelcome tax bill right out of the gate, especially if you're contributing valuable assets like appreciated real estate or equipment.
Okay, that 80% rule is a serious consideration for corporations. How do partnerships compare when handling contributions?
This is where partnerships have a huge advantage, and your sources really emphasize this. When you contribute property to a partnership in exchange for a partnership interest, there is no 80% control requirement. None.
No 80% test at all?
Nope. The sources explicitly say you can contribute property for even a tiny percentage interest, say 1%, and it's generally a non-taxable exchange. This makes bringing in new partners later or just adding more assets yourself much, much simpler from a tax perspective compared to corporations and their strict Section 351 rules.
Wow, that's a massive difference in flexibility. Much easier entry. What about basis rules when contributing to a partnership?
Similar principle. Initially, your starting basis in your partnership interest is generally your adjusted basis in the property you contributed. But here's a really key difference, the material mentions.
Yeah.
Your basis in your partnership interest also gets adjusted for partnership liabilities. Specifically, it increases by your share of any partnership debt.
So if the partnership takes out a loan, my basis goes up.
Effectively, yes, by your allocable share, or if it takes property subject to debt. This inclusion of partnership debt in your outside basis, your basis in the partnership interest itself, is a unique and super important feature of partnerships. It becomes crucial later for things like deducting losses and taking distributions tax-free.
Okay, debt boosts partner basis. Good
Yeah.
to know. And partnership's basis in the asset I contributed.
That's usually just a carryover basis from you, the contributing partner. Simple carryover.
Now, you mentioned something earlier about built-in gains or built-in losses for partnerships. What's that about?
Yes. It's basically a fairness rule. Let's say you contribute property to the partnership, and at the time you contributed, its fair market value is different from your tax basis. Maybe it's appreciated, maybe it's depreciated.
Okay.
That difference that existed before it went into the partnership, that's the built-in gain or built-in loss.
Got it. Pre-contribution difference.
Exactly. And the rule, as your sources note, is that when the partnership later sells that specific piece of property, any gain or loss that was built in at the time of contribution must be allocated specifically back to you, the contributing partner.
Only to me, not shared.
Only the built-in part goes back to you. Any gain or loss that happens after the property is in the partnership, that gets shared among all the partners according to the partnership agreement.
I see. So it prevents me from, say, contributing highly appreciated property and having the other partners effectively share my pre-existing tax liability when it's sold.
Precisely. It locks that pre-contribution tax gain or loss benefit onto the partner who brought the asset in. Keeps things fair.
Clever. Okay. And sole proprietorships. Contributing assets must be the simplest here, right?
Oh, by far. It's a complete tax non-event. For tax purposes, you are the sole proprietorship. So putting assets into it, you're just moving them from your left pocket to your right pocket.
Yeah.
No tax consequences at all.
Makes sense. So pulling this contribution piece together, the sources strongly suggest partnerships and sole proprietorships are way more advantageous if you're putting in appreciated property.
Absolutely. because they completely avoid that complex, potentially tax-triggering 80% control test that C and S corporations have to deal with under Section 351.
That's a really clear takeaway. If initial contributions involve appreciated assets, that's a big check mark for flow-throughs, especially partnerships.
It's a major planning point right at formation.
Okay, we've got the business formed, assets are in. Now for the main event, really, the heart of the operation. How is the actual profit taxed? This is where that whole double taxation idea for C Corp really comes into play, isn't it?
This is arguably the single most impactful tax difference. And yeah, it's a central theme running through all the source material. The core conflict is definitely the C corporation's potential double taxation versus the single layer of tax you see with flow-through entities, that's your partnerships, S Corp, sole proprietorships, and most LLCs.
Okay, let's dissect that C Corp double whammy first. How does it work?
Right. So level 1 tax happens at the corporate level. The C corporation is its own separate taxpayer in the eyes of the IRS. It calculates its net income, and it pays federal income tax directly on that profit.
And the rate.
Your sources specify the current rate is a flat 21%. So, simple example. Business makes $100 of profit. The C Corp writes a check to the IRS for 21%. That leaves $79 in the company account.
Okay, $21 gone. That's layer 1. Where does layer 2 hit?
Layer 2 hits when that remaining $79 of after-tax profit is distributed out to the shareholders. Typically, this happens through dividends.
So when the company pays me, the owner, that money.
Exactly. The shareholders receive those dividends, and guess what? They pay tax on them again, this time on their personal tax returns.
So wait, that same original $100 of profit gets taxed at 21% inside the corporation?
Mm-hmm.
And then the money that's left over, the $79, gets taxed again when it lands in my bank account as a dividend.
That's the essence of double taxation, yes. Now, for individual shareholders, these qualified dividends usually get taxed at preferential rates.
Preferential how? Not my top regular rate.
Correct. Typically 0%, 15%, or 20%, depending on your overall taxable income bracket.
Yeah.
So it's not usually taxed at your highest ordinary income rate, but it's definitely a second tax bite out of the same underlying profit.
Right. Still a second tax. Ouch.
Precisely. And your sources also make a point to mention the net investment income tax, or NII tax.
Ah, the 3.8%.
That's the one.
Curious.
For higher income individuals, those above certain adjusted gross income thresholds, the source mentions $200,000 single, $250,000 married filing jointly. That extra 3.8% tax can also apply to these dividends.
So the second layer could be taxed at, what, up to 23.8% potentially?
Potentially, yes.
Yeah.
20% top capital gain rate plus the 3.8% II tax. So you see how the combined effective tax rate on corporate profits that are actually distributed as dividends can get pretty high. You've got the 21% corporate tax plus potentially up to 23.8% on what's left.
Wow. Yeah, that adds up fast. Seems like a powerful reason not to be a C Corp if you plan to take profits out. But you mentioned something about delaying that second tax.
Yes, and this is the C Corp's potential strategic advantage in certain situations. If the C Corporation doesn't distribute its earnings as dividends,
It just keeps the cash, reinvests it.
exactly. If it holds on to that $79 of after-tax profit inside the business, maybe to fund growth, buy equipment, whatever, then that second layer of tax on dividends is delayed. It doesn't happen until those profits are eventually paid out, or maybe realized by the shareholder in another way, like selling their stock at a gain that reflects those retained earnings.
Ah, okay. So if the plan is to be profitable but plow everything back into the business for years.
Then paying only the 21% corporate rate initially might actually be preferable if the owner's personal tax rate is significantly higher than 21%. You delay that higher personal tax bite.
Got it. So C Corp isn't always double taxed right away, especially if profits stay in the business. Okay, what about the other side? The flow-through entities, S Corp, partnerships, sole props. How's their income taxed?
Much simpler in concept. With flow-throughs, the income is taxed only once.
Just one layer.
Just one layer at the owner level. The entity itself, the partnership, the S Corp, the LLC tax that way, generally doesn't pay any federal income tax. Instead, the profit or loss flows through the entity.
Like water through a pipe.
Kind of, yeah. And it lands directly on the owner's personal income tax returns. And here's the key thing. This income is taxed to the owners when the business earns it, whether or not they actually take the cash out.
Wait, so even if the profit is just sitting in the business bank account, I still owe personal income tax on my share of it that year?
Correct. It's taxed when earned by the business, not when distributed. And that income is taxed at the individual owner's ordinary marginal income tax rates. Your sources list the current brackets ranging from 10% up to 37%.
Okay, so my personal rate applies directly to my share of the business profit. And that rate could be lower or maybe even higher than the C Corp's flat 21%.
Exactly. That comparison, your personal marginal rate versus the 21% corporate rate, is absolutely fundamental to this whole decision.
Makes sense. Now, for businesses with multiple owners, like partnerships and S Corp, how is the income divided up?
Typically, the income, losses, deductions, credits, they're allocated among the owners based on their ownership percentages. Pretty straightforward.
So if I own 30%, I get 30% of the income reported on my return.
Usually. But here's another area where partnerships offer unique flexibility, something your sources highlight.
More partnership flexibility.
Yes. While S-corps generally have to allocate strictly based on ownership shares, a partnership agreement can actually specify different ways to allocate various items. You can have special allocations that aren't directly tied to capital percentages.
Like allocating more depreciation to one partner, maybe.
Potentially, yes,
Hey.
if it has substantial economic effect, which is a whole complex area of rules. But the point is, partnerships offer a level of customization in allocating the tax consequences that S-corps just don't have.
Interesting. That could be really valuable for complex deals or partners contributing different things. Okay, let's tackle the elephant in the room for active owners, self-employment tax.
Ah, yes, SE tax, a major factor for active owners in flow-throughs. It covers your Social Security and Medicare contributions when you work for yourself.
And the rate is?
It's roughly 15.3%, applied to 92.35% of your self-employment earnings, up to the Social Security wage base for that portion.
Okay, 15.3%. Who pays that in the different flow-through entities?
Sole proprietors. They pay SE tax on basically all their net business income. Active partners in a partnership, they generally pay SE tax on any guaranteed payments they receive for services and on their distributive share of the partnership's ordinary business income.
So potentially on a lot of their income from the partnership if they're active.
Yes, it can be a significant additional tax burden. But, and this is probably one of the biggest takeaways from your sources regarding S-corp.
The big S Corp advantage.
Exactly. S-corporation business income that flows through to a shareholder is generally not subject to self-employment tax.
Whoa, wait. The profit that flows through my S Corp avoids that whole 15.3% SC tax hit?
That's the key. Now, there's a catch. Active S-corp shareholders, those who work in the business, are required by the IRS to take a reasonable salary for the services they perform.
Okay, so I have to pay myself a salary.
Yes. And that salary is subject to regular payroll taxes, FICA. The S-corp pays the employer half, the shareholder employee pays the employee half, and the corporation deducts its half. It's like any employee's salary.
Right. FICA on the salary part.
But here's the magic. Any business profit beyond that reasonable salary, that can flow through to the shareholder as a distribution, and it's not subject to SE tax.
Ah, so I pay FICA only on the salary portion, and the rest of the profit comes through without the extra SE tax.
That's the potential tax saving. It allows active owners to potentially shield a significant portion of their business earnings from that 15% SE tax, making the S-corp structure very attractive compared to a partnership or sole proprietorship, where all the active earnings are generally hit with SE tax. Determining reasonable compensation is key, of course.
Okay, that SE tax angle is a huge draw for S Corp. Makes perfect sense. Now, we mentioned the net investment income tax, the 3.8% II tax with C Corp dividends. Does that ever apply to flow-through income?
It can, yes, but typically only to passive owners.
Passive, like someone who just invests money but doesn't work there.
Exactly. If a partner or an S-corp shareholder is not actively involved in the business operations, doesn't meet material participation tests, their share of the flow-through business income might be considered passive income. And if their overall adjusted gross income is above those high thresholds, 250K MFJ, then yes, that passive business income could be subject to the 3.8% in II tax.
But not for active owners.
Generally, no. Income from an actively managed sole proprietorship or an active partner share or an active S-corp owner share is usually considered non-passive, so it avoids the NI tax. It gets hit with SE tax instead, except for the S-corp flow-through part.
Okay. NII tax mostly for passive, high-income owners of flow-throughs. One more piece for income, the qualified business income deduction, QBI. Where does that fit?
The QBI deduction. Section 199A. This was a big change from the 2017 tax reform, and it's a substantial benefit only for owners of flow-through entities.
You've only flow-throughs, not C Corp.
Correct. C corporations don't get it. But individual owners of partnerships, S-corp, and sole proprietorships generally can take a deduction on their personal return for up to 20% of their qualified business income.
20% deduction. That sounds pretty good.
It can be very good. Now, there are various limitations based on the owner's overall taxable income. The type of business, some service businesses are restricted, the amount of W-2 wages the business pays, and the basis of property it holds. But for many flow-through businesses, this deduction directly reduces the owner's taxable income.
So it effectively lowers the tax rate on my business profits.
Exactly. It makes the effective tax rate on flow-through income potentially much lower than the nominal statutory rate, pushing the scale further towards flow-throughs compared to C-Corp, where this deduction isn't available on the corporate income itself.
Man, okay. That's a ton of variables for taxing income. Double versus single tax, the specific rates, SE tax implications, NII tax for passive folks, the QBI deduction, and that partnership allocation flexibility.
It's a lot to juggle.
So based on everything in the sources, how do you decide? When does a C-Corp look better for income, and when does a flow-through win?
The sources really frame it as a balancing act. You have to weigh primarily two things. One, the owner's individual marginal tax rates compared to the C-Corp's flat 21%. And two, the business's plan for retaining earnings versus distributing them.
Okay, when does the C-Corp potentially win on income tax?
It might be better if the owners are already in the very highest individual tax brackets, say the 35% or 37% brackets, well above 21%. And crucially, if the business plans to retain most or all of its profits for significant reinvestment.
Why that combination?
Because the C-Corp's initial 21% tax hit is lower than their personal rate. And since the profits are staying in the business, that second layer of tax on dividends is delayed indefinitely. So in that specific scenario, high owner rates, high earnings retention, the C-Corp can be more tax efficient, at least for a while.
Okay. And when are flow-throughs generally better for income?
Flow-throughs usually come out ahead if the owner's individual marginal rates are lower than or maybe comparable to that 21% C-Corp rate. Or, even if their rates are higher, if the business plans to distribute earnings regularly.
Why?
Because paying tax only once at the owner's rate, especially when potentially lowered by the QBI deduction, generally beats paying the combined C-Corp double tax when profits actually come out to the owners.
Makes sense. And then within the flow-through world, S-Corp versus partnership.
It comes down to those specific advantages. The S-Corp offers that potentially huge SE tax-saving opportunity for active owners on their share of profits. That's often the deciding factor. But partnerships offer that unmatched flexibility in allocating income and losses among partners, which might be critical for certain business structures or deals.
Right. Weighing SE tax savings against allocation flexibility. Okay. The sources give us example one to nail this down. Don and Mary, equal active owners, profitable business, and they plan to retain the earnings.
Yep, a perfect scenario to test the income tax rules.
Scenario one. Don and Mary are in the lowest individual tax brackets. What entity wins?
The source points directly to the S corporation.
Why S-Corp?
Okay, follow the logic. First, their individual tax rates are low, definitely lower than the 21% C-Corp rate. So paying tax once at their low rate is better than the C-Corp's initial 21% hit. Second, they get the benefit of the QBI deduction, lowering their effective tax rate even further. Third, compared to a partnership, the S-Corp is better here because it avoids the SE tax on their share of the business income flowing through beyond any salary. Since they're active owners, that SE tax saving is significant.
Got it. Low rates plus QBI plus no SE tax on profits equals S-Corp wins in this case. Now, scenario two. Same situation, but Don and Mary are in the highest individual tax bracket.
Here, the source flicks its recommendation and says C corporation.
Why the C-Corp now?
Because their individual marginal rates, say 37%, are much higher than the C-Corp's flat 21% rate. And critically, they plan to retain the earnings. So only that initial 21% corporate tax applies for now. They avoid having that income flow through and hit them at their much higher personal rates. The double tax is deferred because no dividends are being paid.
Wow. That example makes it crystal clear. Just changing their personal tax bracket completely flips the recommendation because of that earnings retention plan.
Exactly. It shows how comparing the rates and knowing the distribution strategy is absolutely key to the income tax decision. Even with that potential double tax looming, the lower 21% C-Corp rate can be very attractive if profits are staying in the business and the owners are in high personal brackets.
Okay, income tax covered. Let's flip the coin now and talk about losses. What happens if the business loses money? Super common for startups, right? Can the owners get any tax benefit from those losses personally?
Right. Dealing with losses, especially early on, is crucial. And this is another area where flow-through entities generally have a significant advantage over C-Corp. particularly for startups expecting some initial red ink.
Why the advantage?
Because, as your sources highlight, losses from partnerships, S-corp, and sole proprietorships can potentially flow through to the owner's personal tax returns. And then those owners might be able to use those business losses to offset other personal income, like wages, investment income, etc., reducing their overall personal tax bill for the year.
Potentially flow through.
Yeah.
Might be able to use them. Sounds like there are catches again.
Oh, absolutely. It's not automatic. The sources detail several hurdles or limitations that an individual owner has to clear before they can actually deduct those flow-through losses on their personal return. Think of them like a series of gates the loss has to pass through.
Okay, gate number 1.
Tax basis limitation. This is fundamental. You can only deduct losses up to the amount of your adjusted basis in your ownership interest, your stock basis in an S-corp, or your partnership interest basis. If a $10,000 loss flows through to you, but your basis is only $6,000, you can only deduct $6,000 this year.
What happens to the other $4,000?
It's suspended and carried forward. You can potentially deduct it in a future year if you increase your basis, maybe by contributing more capital or having future profits allocated to you, or in a partnership, maybe by the partnership taking on more debt that increases your basis.
Okay, basis limit first. Gate 2.
At-risk limitation. This is similar to basis, but looks at the amount you are economically at risk in the activity, essentially the amount you personally stand to lose. It's often the same as basis, but not always. Certain types of debt, called non-recourse debt, where you're not personally liable, might increase your basis, but not your at-risk amount. Losses are limited to your at-risk amount.
Basis and at risk. Got it. Gate 3.
Passive activity loss, PL limitations. This is a big one, especially for rental activities or businesses where the owner isn't heavily involved. If the business is considered a passive activity for you, meaning you don't materially participate, according to specific IRS tests,
Then what?
then any losses from that passive activity can generally only be used to offset passive income you might have from other passive activities. You usually can't use passive losses to shelter your active income, like wages, or your portfolio income, like interest and dividends.
So if I'm just a silent investor, my losses might get stuck.
They could be limited by the PL rules, yes. Being actively involved, materially participating, is key to getting around this limitation for operating businesses.
Okay, basis, at risk, PLL.
Is there a fourth gate?
Yes, one more big one. Excess business loss limitations. This is an overall annual cap. For individual taxpayers, there's a limit on the total amount of net business losses from all your trades or businesses combined that you can deduct against your non-business income, like wages, interest, etc., in a single year.
There's a dollar limit.
Yes, it's indexed for inflation each year. For 2024, for example, it's around $300,000 for single filers and $600,000 for married filing jointly. Any business losses above that threshold in a year are considered excess business losses.
And what happens to those excess losses?
They're not permanently lost, but they're carried forward to the next year, treated as part of that year's net operating loss, NOL carry forward.
Okay, wow. So flow-through losses can be really powerful, but you need enough basis, you need to be at risk, you generally need to be active, materially participating to avoid PL limits, and you have to stay under that overall excess business loss cap for the year.
That's the gauntlet they have to run, exactly.
So how do C corporations handle losses? Completely different.
Completely different. When a C corporation loses money, that loss creates a net operating loss, or NOL, within the corporation.
It stays inside the company.
Yes, it's trapped inside the C Corp. The owners don't see it on their personal returns at all.
So what good is the NOL?
It's generally carried forward indefinitely to offset future corporate profits. So if the C Corp becomes profitable down the road, it can use those past NOLs to reduce its taxable income then.
Is there a limit on using them?
Yes. Your sources note that for NOLs generated in recent tax years, generally after 2017, their use is limited. They can only offset up to 80% of the corporation's taxable income in a future year.
Only 80%. So even if they have huge NOLs, they might still pay some tax if they become profitable.
Correct. So the big picture disadvantage for owners of a C Corp expecting losses. Those losses provide absolutely no immediate tax benefit on their personal returns. The benefit is stuck inside the corporation, it's delayed until the company hopefully makes profits later, and even then its use is limited by that 80% rule.
That sounds way less appealing than the potential immediate offset from flow-through losses.
For businesses expecting losses, especially early on, it usually is. Flow-throughs offer that potential for immediate personal tax relief, which can be really valuable cash flow for a startup. Even if a flow-through loss is limited in the current year by, say, basis rules, it's typically carried forward by the owner and can often be used later when basis increases or other limitations lapse. And it's not subject to that C Corp 80% NOL usage limitation.
Okay, flow-throughs win for losses. Now, you mentioned a subtle difference between partnerships and S-Corp regarding basis and losses involving debt. Can you recap that?
Right. This is a key nuance your sources point out that can sometimes make partnerships slightly more advantageous for deducting losses. Remember how we said a partner's basis in their partnership interest includes their share of the partnership's debts?
Yeah, the outside basis gets boosted by debt.
Well, that's generally not true for S-corporation shareholders. Corporate-level debt taken on by the S-corp usually doesn't increase the shareholder's basis in their stock, unless the shareholder personally guaranteed the debt or directly loaned money to the S-corp, which creates debt basis, but that's different and sometimes more limited.
So corporate debt doesn't help S-Corp stock basis much?
Generally, no.
Hmm.
Because partners can often include their share of partnership debt in their basis calculation, they frequently end up with a higher overall basis in their partnership interest compared to what an S-corp shareholder might have in their stock, especially if the business relies heavily on bank loans or other third-party financing.
And higher basis means?
Higher basis means they can potentially deduct more of the flow-through losses before hitting that first gate, the basis limitation. An S-corp shareholder might hit their basis limit much sooner if the business is funded with debt, potentially suspending more of the losses.
Ah, okay. So flow-through is generally better for losses, but partnerships might get a slight edge over S-Corp if the business has significant debt, because that debt helps create more basis for the partners to absorb losses.
That's the precise takeaway on losses from the material. Flow-throughs are usually preferred for loss situations, and partnerships might handle debt finance losses a bit more effectively due to the basis rules.
Okay, let's bring this home with example 2 from the sources. Don and Mary again. Equal, active owners. They have substantial basis invested. They are expecting losses initially, maybe for the first couple of years, and they have other personal income they'd like to shelter with those business losses.
Right. Using those startup losses efficiently is the name of the game for them in this scenario.
So what entity does the source recommend here?
S-corporation or partnership. Either flow-through works well.
And why is a C corporation explicitly not recommended?
Because, just like we discussed, the C Corp losses would be NOLs trapped inside the entity. Don and Mary couldn't use them immediately to offset their other income. The tax benefit would be delayed, dependent on future corporate profits, and limited by the 80% rule. Not helpful during the cash-strapped startup phase.
Makes sense. And why are S corp or partnership the winners?
Because the losses flow through directly to Don and Mary's personal returns. The example states they have substantial basis, so they likely clear the basis gate, and they're active participants, so they likely clear the appeal gate. They also presumably have enough other income that the excess business loss limit isn't an issue initially. This means they can likely use those business losses right away to reduce the tax they owe on their other income, providing immediate financial relief.
So the flow-through structure gives them that immediate loss benefit. That example really drives home the advantage for startups expecting losses. Okay, next big tax differentiator. How do owners who actually work in the business get paid? Compensation, payroll taxes, benefits.
Yes, a very significant area with clear differences, especially around those payroll taxes, FICA or SE tax, and how fringe benefits, like health insurance, are treated for owners.
Let's look at C&S corporations first. How do they handle paying owner workers?
In both C and S Corp, shareholders who work in the business can be treated as regular W-2 employees.
Just like any other employee?
Pretty much. This means they receive a salary for the services they provide. That salary is, of course, ordinary income to the shareholder employee, reported on their W-2.
And the corporation's role?
The corporation acts as the employer. It withholds income tax and the employee's half of FICA taxes, Social Security and Medicare, from the paycheck. And importantly, the corporation pays the other half of the FICA taxes itself, the employer's share.
Okay, and tax deductions.
The corporation gets a tax deduction for both the salary it pays and for the employer's share of FICA taxes it pays. This deduction reduces the corporation's taxable income if it's a C Corp, or the amount of income flowing through to the owners if it's an S Corp.
So the business effectively gets a deduction for the salary and half the payroll tax cost associated with it.
Correct. Now let's contrast that with partnerships.
How do partners who work in the business get compensated? Can they be employees?
No, this is a fundamental difference. Partners cannot be employees of their own partnership. Instead of a salary, partners typically receive guaranteed payments for the services they provide.
Guaranteed payments. Sounds like a salary.
Functionally similar, yes. And the partnership does get to deduct these guaranteed payments when calculating its ordinary business income, just like a corporation deducts employee salaries.
Okay, so the business still gets a deduction.
Yeah.
What's the tax difference for the owner and payroll taxes?
Here's the critical difference: payroll tax treatment. Since a partner isn't an employee, the partnership itself does not pay the employer's share of FICA taxes on those guaranteed payments.
So who pays it?
The partner does. The guaranteed payment is treated as both ordinary income and self-employment income to the partner receiving it. This means the partner is responsible for paying the entire self-employment tax, both the employee and employer portions, that full 15.3% on those guaranteed payments via their personal tax return.
Ouch. So the owner bears the full SE tax burden on their compensation in a partnership. Whereas in a C or S corp, the corporation picks up half the FICA on the salary and gets a deduction for it.
Exactly. That's a significant difference in who effectively bears that payroll tax cost. Huge implications for net take-home pay.
Wow. Okay. And sole proprietors, how do they get paid?
A sole proprietor can't pay themselves a salary or receive tax-advantaged fringe benefits as an employee. Their compensation is simply the net profit of the business shown on their Schedule C. And as we've mentioned, that net profit is generally subject to self-employment tax.
So similar to the partner, they bear the full SE tax burden on their earnings. Got it. Okay. The FICUS tax split is a very clear differentiator. What about those qualifying fringe benefits, like health insurance? That's a big expense and a valuable benefit for many owners.
Yes, and this is another area where your sources point to a distinct tax advantage, particularly for C corporations.
How are fringe benefits, like health insurance premiums paid by the business, treated for owners in partnerships?
For partners, if the partnership pays for benefits like health insurance for them, the cost is generally treated as an additional guaranteed payment.
Okay, so the partnership deducts the cost.
Yes, the partnership gets the deduction. However, the value of that benefit is considered taxable ordinary income to the partner receiving it, and it's typically subject to self-employment tax along with their other guaranteed payments.
Wait, seriously? The business pays for my health insurance, gets a deduction, but I have to report the value as income and pay income tax and SE tax on it. That seems really disadvantageous.
It does feel counterintuitive, but that's generally the rule for partners receiving benefits. Not ideal. Now, compare that to C corporations.
Okay, how do C Corp handle owner benefits?
This is where they shine, according to the sources. For C corporations, qualifying fringe benefits paid for shareholder employees, things like health insurance premiums, group term life insurance up to certain limits, etc., are generally deductible by the corporation.
Okay, deduction for the business.
And here's the key. They are typically treated as non-taxable income to the shareholder employee receiving the benefit.
Non-taxable to the owner. Completely tax-free benefit.
For qualifying benefits, yes. This is a major tax perk available primarily through the C Corp structure for owners. The corporation gets the deduction, the owner gets the benefit tax-free. Win-win.
Wow, that's a huge difference compared to the partnership treatment. Okay, what about S Corp? They can pay salaries like C Corp. Do they get the same tax-free benefit treatment for owners?
This is a critical limitation for S Corp, especially for founders or majority owners. While S corporations can deduct the cost of qualifying fringe benefits paid for their shareholder employees,
Like C Corp.
the benefit is non-taxable to the shareholder only if that shareholder owns 2% or less of the S Corp stock.
Only 2% or less. What about owners who own more, like most founders?
If a shareholder owns more than 2% of the S Corp, which is almost always the case for active owner managers, then the value of those fringe benefits is considered taxable income to that shareholder, even though the S Corp still gets the deduction.
So for most S Corp owner-operators, fringe benefits like health insurance are taxable to them personally, essentially the same treatment as in a partnership.
Basically, yes. The S Corp gets the deduction, but the 2% owner includes the value in their W-2 income. Only the C Corp generally offers that valuable combination of corporate deduction and tax-free receipt for the owner for qualifying fringes.
That is a really crucial distinction. The sources are right. If providing tax-free health insurance or other big fringe benefits to the owners themselves is a high priority, the C Corporation really stands out.
It's a major planning point when considering compensation structure.
So let's sum up compensation. Based on the sources, which entity comes out on top?
It's a bit mixed. Both C and S Corp have an advantage over partnerships and sole proprietorships because the corporation pays and deducts the employer's half of FICA on salaries, reducing the overall payroll tax burden compared to the owner paying full SE tax.
Okay, CS Corp advantage on FICA's tax burden sharing.
But the C corporation has that very distinct, often significant advantage regarding qualifying fringe benefits because they can potentially be non-taxable to the owners. That's not the case for partners or for 2% S Corp owners.
Right. Partnership sole props mean owners pay full SE tax and benefits are taxable to them. C Corp wins big on tax-free benefits.
That's a fair summary of the source's points.
Okay, let's cement this with example 3 from the sources. Don and Mary again. Equal, active owners. Business is expecting profits. They want reasonable compensation and significant fringe benefits, like health insurance, and they don't plan on taking distributions beyond compensation benefits right now.
Right. Example 3 is laser-focused on the best way to structure their pay and benefits.
So what's the recommended entity in this specific scenario?
The source points squarely at the C corporation.
Why C Corp? What's the deciding factor?
2 main reasons align with our discussion. First, the C Corp allows them to take reasonable salaries, which are deductible by the corporation, and the corporation pays half the FICA. But the real kicker, the factor the source emphasizes for this example, is the fringe benefits.
The tax-free aspect.
Exactly. In a C Corp, those valuable qualified benefits like health insurance can be provided tax-free to Don and Mary as shareholder employees.
And why isn't an S Corp the best choice here, even though it also allows salaries?
Because Don and Mary each own 50%. That's way over the 2% ownership threshold for S Corp regarding fringe benefits. So if they operated as an S Corp, the value of their health insurance and other qualifying benefits would be taxable income to them personally. The C Corp avoids that tax hit on the benefits.
Got it. S Corp loses out because they're 2% owners.
Yeah.
And a partnership.
Even less favorable in this scenario. They'd receive guaranteed payments instead of salaries, meaning they pay the full SE tax burden themselves, and the fringe benefits would also be taxable income to them, just like in the S Corp. The C Corp structure is clearly superior when the goal is tax-efficient compensation that includes significant, valuable fringe benefits for the owners.
That example really hammers home the C Corp advantage for tax-free benefits. Okay, new scenario. Let's say the business is humming along, making good profits, and the owners want to take some money out. Not compensation for work, just pulling out profits. But they're not shutting down yet, just taking an operating distribution. What are the tax implications?
Right, getting money out while still operating. There's another critical point of comparison where the entities differ significantly. Your sources highlight a general theme here. Taking money out of a C corporation as a distribution, a dividend, is almost always a taxable event, whereas distributions from partnerships and sole proprietorships, typically not taxable, at least up to the owner's basis. S Corp, again, are a bit more complex, somewhere in the middle.
Okay, let's start with C corporations and operating distributions, money coming out.
Distributions of cash or property from a C corporation to its shareholders are generally considered taxable dividends, assuming the corporation has sufficient earnings and profits, EMP, which is a technical tax measure of accumulated and current profits.
So if the C Corp has profits, distributions are dividends.
Generally, yes, to the extent of EMP. And as we covered earlier, those qualified dividends are taxed to individual shareholders at those preferential capital gain rates, 0.1520%, plus potentially that 3.8% ADI tax.
So taking cash out as a dividend basically triggers that second layer of tax we talked about immediately.
If there's ENP, yes. Now, what about distributing property instead of cash? Say the C Corp owns a piece of land and distributes that. It gets more complicated and usually less favorable. If a C Corp distributes property, like land, equipment, instead of cash, the amount of the distribution is the property's fair market value, FMV, at the time.
Okay, owner receives FMV.
But here's the kicker for the corporation. The C corporation itself is treated as if it sold that appreciated property for its FMV right before distributing it. This means the corporation recognizes gain on any appreciation, the difference between FMV and the property's basis.
The corporation pays tax just for distributing the property.
It recognizes the gain, yes, which increases its taxable income and its EMP. Importantly, corporations generally cannot recognize losses on distributed property in non-liquidating situations. So gain is recognized, loss is not.
Wow. Okay, so corporate level gain recognition. Then what happens to the shareholder?
The shareholder receiving the property is treated as receiving a taxable dividend equal to the property's FMV, to the extent of ENP, which was likely just increased by the corporate gain. and their basis in the property they just received becomes its FMV.
So distributing appreciated property from a C Corp sounds like a potential double hit again. Tax at the corporate level on the appreciation and a taxable dividend to the shareholder based on the full market value. Pretty costly way to get property out.
It often is. Very tax inefficient for appreciated property distributions. Now, how do S corporations handle operating distributions? The sources say their rules are layered and complex. They are. Tracking basis in something called the Accumulated Adjustments Account, a FILA, is absolutely critical for S Corp. Think of the money coming out of an S Corp as being drawn from different potential buckets in a specific order.
Okay, bucket number 1.
Bucket 1 is the S Corporation's AAA. This account basically tracks the S Corp's cumulative income that has already been taxed to the shareholders, because it flowed through, but hasn't yet been distributed. Distributions from AAA are generally non-taxable to the shareholders.
Non-taxable, okay. But does it affect anything?
Yes, crucially, these non-taxable distributions reduce the shareholders' basis in their S Corp stock.
Okay, bucket 1, AAA non-taxable, reduces basis. What's next?
Bucket 2 applies only if the S Corp used to be a C Corp and still has some leftover earnings and profits, E&P, from its C Corp days hanging around.
Yeah.
If so, distributions after AAA is depleted are considered to come from that old C Corp E&P bucket.
And distributions from C Corp E&P are?
Taxable dividends to the shareholders, just like distributions from a regular C Corp, taxed at preferential rates.
Ah, so a hidden C Corp layer potentially inside the S Corp. Okay, bucket 2, C Corp E&P taxable dividend. What's bucket 3?
After exhausting both AAA and any lingering C Corp E&P, distributions are then considered a return of the shareholders' remaining basis in their S Corp stock, beyond what was tracked in AAA. These distributions are, again, non-taxable.
Bucket 3, remaining stock basis non-taxable. Reduces basis further, I assume.
Yes, reduces basis down to 0. And what if there's still more distribution after all basis is gone?
Bucket 4.
Bucket 4. Any distributions that exceed the shareholders' total basis, AAA plus other basis, are taxed as capital gain, usually long-term capital gain.
Wow. Okay, so S Corp distributions. Non-taxable, AAA, reduces basis. Potentially taxable dividend, old C Corp E&P. Non-taxable again, rest of basis. Then finally capital gain. That sounds like you absolutely need good record keeping.
You absolutely do. Tracking AAA and stock basis is non-negotiable for S Corp making distributions. Now, what about S Corp property distributions during operation?
Does it follow the same bucket system? What about gain recognition?
The taxability of the distribution to the shareholder does follow that same complex AAA E&P basis gain ordering system based on the property's FMV. But similar to C Corp, the S Corporation itself recognizes gain, but generally not loss, on distributing appreciated property, as if it sold the property for FMV.
So the S Corp recognizes gain too?
Yes, and that gain flows through to the shareholders on their K1s, increases their stock basis, and then the distribution of the property, valued at FMV, runs through the ordering rules to see how it's taxed to them. The shareholders' basis in the property received is its FMV.
Okay, so both C and S Corp recognize gain at the entity level when distributing appreciated property during operations, and the distribution amount is FMV. This seems like a consistent downside for corporations with appreciated property. How do partnerships handle operating distributions? The sources hinted they're much better here.
Significantly better, generally, especially when property is involved. This is a major advantage highlighted in the material. For partnerships, distributions of cash or property to a partner are typically non-taxable, as long as they don't exceed the partner's basis in their partnership interest.
Non-taxable up to basis. And remember, partner basis often includes their share of partnership debt, right?
Exactly. That potentially higher basis cushion, due to including debt, means partners can often receive quite substantial cash distributions from a partnership without triggering any immediate tax.
When does a cash distribution from a partnership become taxable?
Only if the amount of cash distributed exceeds the partner's basis in their partnership interest before the distribution. That excess cash is then treated as capital gain. Note the emphasis on cash.
Okay, cash over basis, capital gain. What about distributing property from a partnership while operating? Is gain recognized? Is the amount FMV?
This is the huge difference. First, the amount of a partnership property distribution for tax purposes is generally the partnership's adjusted basis in the property, not its fair market value.
Distributed amount equals partnership's basis, not FMV.
Wow, big difference. And second, and crucially, your sources emphasize that generally no gain or loss is recognized by the partnership or the partner on the distribution of property itself during operations.
No gain recognized by anyone just for distributing property.
Generally, no. The distribution itself is non-taxable. It just reduces the partner's basis in their partnership interest by the basis of the property distributed, and the partner's basis in the property they receive. It's typically the same as the partnership's adjusted basis was in that property, with a limit it can't exceed the partner's basis in their partnership interest.
Okay, hold on. Partnership distributes appreciated property. No gain to the partnership. No gain to the partner, usually. Distribution amount is the partnership's basis, not FMV. Partner takes the property with a carryover basis. That sounds incredibly favorable compared to corporations.
It is, especially for businesses holding appreciated assets like real estate that they might want to distribute out to partners over time without triggering immediate tax consequences. It's a massive planning advantage for partnerships.
Unbelievable difference. And sole proprietors again, taking cash or property out.
Simplest of all, as usual, owner withdrawals of cash or property from their sole proprietorship are never considered taxable events. You're just moving your own money or assets around. No tax impact.
Okay, summing up operating distributions. Based on your sources, which entity is generally the most advantageous for tax-efficiently getting money or property out while still operating?
The sources clearly conclude that partnerships are generally the most advantageous, particularly if distributing appreciated property. They highlight the lack of entity-level gain recognition, the fact that the distribution amount is based on basis, not FMV, and the distribution itself is usually non-taxable up to the partner's potentially higher basis due to debt inclusion.
And the others.
C-Corp distributions are generally taxable dividends, if E&P exists.
Yeah.
S-Corp are complex. They do recognize gain on appreciated property distributions, and their layered distribution rules, plus lack of debt and stock basis, mean distributions can become taxable sooner or in unexpected ways compared to partnerships.
Okay, partnership seems the clear winner for tax-efficient operating distributions, especially with property. Now, the final stage, the end of the road. What happens when the business is actually done and you need to close up shop completely? Liquidating distributions. What are the tax costs of winding down and distributing all remaining assets?
Right, the tax cost of the exit strategy. This can be a really significant and sometimes overlooked factor. Your sources state a general principle here. C and S corporations generally do recognize gain or loss on property distributed during a complete liquidation, which can lead to that potential double tax on appreciation again. Partnerships, on the other hand, generally do not recognize gain or loss at the entity level.
Okay, let's break down liquidation for C corporations first. What happens?
When a C corporation liquidates, it's essentially treated as two distinct taxable events. First, the corporation is treated as if it sold all of its assets at their fair market value, FMV, right before distributing them. So the corporation recognizes gain or loss on the difference between the FMV and its adjusted basis for every single asset it distributes. Okay, corporate level tax event on everything. Gain or loss recognized. Then what?
Second, the shareholders are treated as if they sold their stock back to the corporation in exchange for the assets they receive. So the shareholders recognize a capital gain or loss based on the difference between the FMV of the property they receive in the liquidation and their basis in their C Corp stock. Their basis in the property they receive becomes its FMV.
So any appreciation in the C Corp's assets gets taxed twice upon liquidation, once inside the corporation when it's deemed sold, and then again at the shareholder level when they receive the appreciated proceeds in kind.
That's the potential double tax hit on liquidation for appreciated assets held by a C Corp. It can be a very, very costly exit. Ouch. That sounds potentially brutal. What about S corporations liquidating? Is it the same double hit?
It's similar, but with the S-Corp flow-through twist. S-corporations are treated the same way as C-corporations at the entity level regarding liquidating distributions. The S-Corp recognizes gain or loss on the deemed sale of its assets at FMV versus basis.
Okay, entity-level gain-loss recognition for S Corp too.
Yes, but because it's an S-Corp, that gain or loss flows through to the shareholders on their final K-1s, and it adjusts their basis in their S-Corp stock accordingly.
So the first layer hits the shareholders via flow-through. Then what happens at the shareholder level?
Then, just like with a C-Corp liquidation, the shareholders recognize a capital gain or loss based on the difference between the FMV of the property they receive and their now adjusted stock basis. Their basis in the property received is its FMV.
So even the first layer flows through, you still have a potential 2 layers of tax on the appreciation in an S-Corp liquidation. The gain recognized by the S-Corp flows through and is taxed, and the distribution itself can trigger more gain at the shareholder level.
Correct. It's still structured in a way that can result in two levels of tax on the same appreciation, although the character and timing might differ slightly from a C Corp. It's generally much less favorable than partnership liquidation for appreciated assets.
Okay, C and S corp liquidations can be costly with appreciated assets. How do partnerships handle complete liquidation? The sources suggested much better.
Dramatically better, usually, if the partnership holds appreciated property. This is arguably one of the biggest long-term advantages of the partnership structure. Your sources state that, generally, no gain or loss is recognized by the partnership itself upon making liquidating distributions of property.
No entity-level tax event at all.
Generally, no.
Then
And what about the partners? Do they recognize gain when they receive the assets?
usually not on receiving property. Instead of recognizing gain or loss, the partner's basis in their partnership interest, after all the final adjustments for the year's operations, is essentially allocated or signed to the non-cash property they receive in the liquidation.
So my basis just transfers from the partnership interest to the assets I get back.
Yeah.
Basically, yes. The tax is deferred. A partner generally only recognizes gain on liquidation in very limited circumstances, primarily if the amount of cash they receive exceeds their basis in the partnership interest. Or they might recognize a loss only under specific conditions, like if they receive only cash, unrealized receivables, and inventory, and the basis of those is less than their outside basis.
Wow. So if a partnership holds, say, highly appreciated real estate, and it liquidates by distributing that real estate to the partners, generally, neither the partnership nor the partners pay tax on that huge appreciation at that moment.
Precisely. The tax on all that built-up appreciation is deferred. The partners take the property with a basis derived from their old partnership interest basis, and they won't pay tax until they eventually sell that property personally, maybe years down the road.
That avoidance of immediate, potentially double tax on appreciation at liquidation seems like a massive, massive win for partnerships holding valuable assets long term.
It absolutely is. It makes the partnership structure significantly more favorable than corporations when you're thinking about the tax cost of eventually winding down a business that holds appreciated assets.
Okay, so based on the sources, which entity is most advantageous for liquidation?
The conclusion seems very clear from the material. Partnerships are generally favored if the entity holds appreciated property, because they avoid that entity-level gain recognition and the potential double tax.
However,
The sources also note a flip side. If the entity holds depreciated property, assets worth less than their basis. Corporations, either C or S, might actually be more favorable at liquidation,
why?
because corporations can generally recognize losses on the deemed sale of depreciated property during liquidation. Those losses can potentially offset other gains at the corporate level for C Corp or flow through to offset shareholder income for S Corp. Partnerships, on the other hand, generally don't recognize the loss on distributing depreciated property. The partner just takes the property with a higher basis, deferring the potential loss.
Interesting. So, appreciated assets, partnership wins on liquidation. Depreciated assets, corporation might win on liquidation. Got it.
It depends on what kind of assets you expect to hold at the end.
Let's use example 4 to illustrate. Don and Mary again. Equal owners. This time, it's a passive rental real estate activity. They expect the property value to go up substantially over time, and they're very concerned about the tax hit when they eventually sell or liquidate the whole thing.
Right. Example 4. Appreciated assets at the end of the business life cycle are the key variable here.
So what's the recommended entity for them?
Partnership, unequivocally.
And the reason?
Because, as the source highlights, if they operate as a partnership when they eventually liquidate and distribute that highly appreciated real estate, generally neither the partnership nor Don and Mary will recognize gain at that time. The tax on all that appreciation is deferred until they personally sell the property later.
And why are C or S Corp explicitly less favorable in this specific high appreciation scenario?
Because under either a C or S Corp structure, the corporation itself would recognize gain on distributing that appreciated real estate upon liquidation. That gain gets taxed either at the 21% corporate rate, C Corp, or flows through to Don and Mary's individual returns, S Corp. Plus, Don and Mary would also likely recognize a capital gain on the liquidation based on the difference between the property's FMV and their stock basis. That potential double layer of tax on all that appreciation is completely avoided with the partnership structure in this case.
That example really seals it. The potential tax cost of liquidating appreciated assets out of a corporation versus a partnership can be dramatically different. Huge long-term consideration. Okay, we've walked through the whole life cycle, starting up, operating, getting paid, taking money out, and closing down. What if? What if you pick one entity type and later realize, oops, maybe that wasn't the best choice? Can you switch? Can you convert from one type to another? And importantly, is there a tax cost to changing your mind?
Good question. Because circumstances change, right? And yes, you absolutely can convert between entity types, but your sources make it very clear. The tax costs and the complexity involved can vary enormously depending on which direction you're converting. And again, whether appreciated assets are involved is often a key factor.
Okay, which direction is generally easier and less costly from a tax perspective? Going from a flow-through, like a partnership or S-corp, to a C-corp, or going the other way, from a C-corp to a flow-through?
The sources generally indicate it's significantly easier and usually has a lower potential tax cost to convert from a flow-through entity to a C corporation.
Okay, how does that work? Say I have an S-corp and want to become a C-corp.
For an S-corp converting to a C-corp, you can simply file to revoke your S election.
Yeah.
Boom, you become a C-corp tax-wise going forward. Pretty straightforward. Though, note there's generally a 5-year waiting period before you can elect back into S status again if you change your mind again later.
Revoke the S election. Simple enough. What about converting a partnership or sole proprietorship, like an LLC taxed as one, into a C-corp?
Also generally manageable. If it's an LLC or other unincorporated entity, you can often just use that check-the-box selection we talked about earlier, file Form 8832, and elect to be taxed as a corporation. Alternatively, you could formally incorporate a new C-corp entity and then have the partnership or sole proprietorship contribute its assets and liabilities to the new corporation in exchange for stock.
And that contribution, is it taxable?
It can often be structured as a tax-free Section 351 exchange if the owners of the old entity, who are transferring the assets, end up with at least 80% control of the new corporation immediately after the transfer. So that 80% rule pops up again, but often achievable in this context.
Okay, so converting to a C-corp from a flow-through, generally doable, relatively low tax friction, assuming you handle the mechanics correctly, maybe navigating Section 351. Now, what about going the other way? Converting from a C corporation to a flow-through entity like an S-corp or partnership?
This direction. This is where things can get significantly more complex and potentially much more costly from a tax perspective, especially if the C corporation holds appreciated assets.
More costly. How so? Let's take converting a C corp to an S corp first. How does that happen?
A C corp can elect S corporation status, provided it meets all the S corp eligibility requirements. Owner types, number of owners, single class of stock, etc. You file Form 2553 to make the election. Seems simple enough, right?
Sounds simple, but I sense a but coming.
There's a big but. The sources warn about something called the built-in gains tax, or big tax. When a C corp converts to an S corp, any appreciation that existed in its assets at the time of the conversion gets tagged.
Tagged how?
If the S corp then sells any of those tagged appreciated assets within a certain period after the conversion, currently it's a 5-year recognition period, the S corp may have to pay a corporate-level tax at the highest C corp rate, currently 21%, on the built-in gain that existed at the time of conversion.
So the old C corp appreciation can still trigger a corporate-level tax even after becoming an S corp.
For sales within that 5-year window, yes. That built-in gain after the corporate tax also flows through to the shareholders and is taxed again on their returns, reduced by the corporate tax paid. So converting from C to S can still carry a significant tax cost related to that prior C corp appreciation if assets are sold too soon.
Okay, C to S conversion isn't necessarily a clean break from C corp tax issues. What about the other direction? Converting a C corp to a partnership or a sole proprietorship, maybe an LLC wanting to switch back to default partnership sole prop tax status.
This is often the most tax-expensive conversion route of all, according to the sources. Why? Because generally, to go from a C corp structure to a partnership or sole proprietorship structure for tax purposes, you have to first undertake a taxable liquidation of the C corporation.
A full liquidation, like we just talked about.
Exactly. The C corporation is treated as selling all its assets at FMV, triggering corporate-level gain loss, and then distributing those assets to the shareholders who are treated as selling their stock, triggering shareholder-level gain loss.
So if my C corp has built up valuable, highly appreciated assets over the years, and I decide I want the tax flexibility of a partnership structure instead, I basically have to pay that potentially huge C corp liquidation double tax bill immediately just to make the switch.
That's generally the harsh reality.
Yeah.
The conversion itself triggers the full tax cost of liquidating the C corp.
Wow. That really underscores a critical strategic point, doesn't it? Choosing to be a C corporation initially, It might seem beneficial for certain things, but it can create a massive, potentially unavoidable future tax roadblock if you ever want to switch out of C status into a simpler flow-through structure later on, especially if the business is successful and its assets appreciate significantly.
Precisely. It's a classic tax planning dilemma. The potential ease or significant cost of a future conversion is absolutely a factor that should weigh heavily on the initial entity choice decision. Going into C Corp status is relatively easy. Getting out can be very painful tax-wise.
That definitely makes the initial choice, particularly regarding whether to be a C Corp or maybe an LLC that elects C Corp status, feel much higher stakes. Changing your mind later might not be a practical option if the tax cost is too high.
It's a look before you leap situation, for sure. You need to think about the entire potential life cycle.
Okay, we have really covered the waterfront here. We've walked through the entire life cycle tax implications based on your sources: contributions, taxing income, handling losses, compensating owners, taking money out during operations, the final tax bill on liquidation, and the costs of converting. That was comprehensive.
It really covers the major tax pressure points when comparing these entities. And using the summary points from your sources, we can quickly just tick through the highlights again, see how they stack up side by side across these critical areas.
Good idea. Quick recap. Contributing appreciated property. Where's the advantage?
Partnership and sole proprietorship generally win hands down. Much easier, usually tax-free, avoids that tricky 80% Section 351 control test required for corporations.
Okay, taxation of the actual business income, the big one.
C Corp faces that potential double tax, 21% corporate plus shareholder dividend tax, but the second layer is delayed if earnings are retained. Flow-throughs, partnership, S Corp, sole prop, taxed just once, immediately when earned, at the owner's individual rate, 1037%. Key differences within flow-throughs. SE tax is a burden for active partner sole props, but generally avoided on S Corp profits beyond salary. QBI deduction significantly lowers the effective rate only for flow-through owners, and partnerships have that unique allocation flexibility.
Got it. Deduction of business losses. Who wins when things go bad?
Flow-through entities are generally much better. Losses can flow through to owners' personal returns for potential immediate use if they clear the basis, at-risk, PAL, and excess business loss hurdles. C Corp losses get stuck inside as NOLs benefit delayed and limited. Partnership might have a slight edge over S Corp for deducting losses if the business has debt, because debt boosts partner basis.
Right. Compensation of owners, salary, benefits.
C and S Corp allow owners to be employees receiving salaries, and the corporation pays deducts half the FICA. That's an advantage over partnership sole props, where owners pay the full SE tax burden. But C Corp is distinctly better for providing tax-free qualified fringe benefits, like health insurance, to owners. S Corp benefits are taxable to 2% owners, and partnership benefits are taxable to partners.
Okay. C Corp shines on benefits. Operating distributions. Taking money out while still running.
Partnership is generally the clear winner here, especially if distributing appreciated property. Distributions usually non-taxable up to basis, which includes debt, and crucially, no entity-level gain recognized on property distributions. C Corp distributions are taxable dividends. S Corp distributions are complex, can become taxable sooner, and the S Corp does recognize gain on distributing appreciated property.
Partnership wins on getting operating money property out tax efficiently. Liquidating distributions. Closing down for good.
Again, partnership is generally best if the business holds appreciated assets at the end, because it avoids entity-level gain recognition. Corporations, C or S, might be better if the business holds depreciated assets because they can recognize those losses upon liquidation.
Depends on asset appreciation and depreciation at the end. Finally, converting between entities.
Converting to a C Corp from a flow-through is generally easier and less costly. Converting from a C Corp, especially to a partnership sole prop, which requires a taxable liquidation, or even to an S Corp, due to potential built-in gains tax, can be significantly more complex and much more expensive, particularly if the C Corp holds appreciated assets.
Okay. This whirlwind tour through all those tax implications, it really highlights the stark differences. There are huge trade-offs with every single choice. It just screams that there's no single best entity, right? It absolutely depends on your specific situation, your numbers, your plans, your priorities.
Precisely. There's no magic bullet. You have to do an honest assessment of your business now, and critically, how you realistically project it unfolding in the future. You need to ask yourself questions like, how many owners will there be? What are their roles going to be active, passive? What are your personal income tax brackets now, and where do you expect them to be? Are you anticipating significant losses in the first few years or profits right away? Is the plan to reinvest profits heavily back into the business, or will owners need to take regular distributions to live on? How important are providing tax-free fringe benefits, like health insurance, for the owners? Is that a must-have? Is minimizing self-employment tax a major financial goal for the active owners? Are you contributing assets that already have significant built-in appreciation? Do you anticipate holding assets long-term that are likely to appreciate substantially, making that potential liquidation tax cost a major future concern? How much legal liability protection do you absolutely need, which might push you towards an LLC or core structure regardless of minor tax differences? And let's be honest, how comfortable are you or your advisors with handling complexity in exchange for potential tax savings? S-Corp and partnerships require more sophisticated accounting and tax tracking than sole props or even C-Corp sometimes.
And as those examples clearly showed, changing just one single variable like expecting losses instead of profits, or wanting benefits versus retaining earnings, or having high versus low personal tax rates can completely flip which entity structure looks most advantageous from a tax perspective. It's all about weighing these different factors together, filtering them through your own business reality and your personal financial picture.
Absolutely. These sources you provided lay out an incredible roadmap. They equip you to ask the right questions and, crucially, to understand the profound implications of the answers for your business's financial health.
Well, we have certainly taken a deep dive into the tax heart of these business entities, really dissecting the rules for contributions, income, losses, compensation, distributions, and eventually liquidation or conversion, all based on the detailed material you shared. It's clear there are significant, often competing trade-offs with every single structure.
And understanding these mechanics isn't just some theoretical exercise, right?
Oh.
It translates directly into real dollars cash flow, tax bills saved or paid, and the financial flexibility you have as a business owner to grow, adapt, and eventually exit.
Definitely. And maybe here's a final thought, something for you to chew on as you think about all this. We saw how the C Corp can be great for those tax-free benefits and maybe delaying tax on retained earnings if you're in a high bracket. But it can be potentially disastrous from a tax perspective if you ever want to take appreciated assets out or liquidate or convert to a partnership later because of that double taxation potential.
Right, the potentially costly exit.
Then the S Corp, it offers that great escape from SE tax on profits for active owners, which is huge. But it makes fringe benefits taxable for most owners, and it still faces entity-level gain recognition on appreciated assets when distributing or liquidating, leading to potential double tax issues there, too.
Trade-offs again.
And the partnership. It offers incredible tax flexibility for contributions, for operating distributions, especially property, and for liquidating appreciated assets without immediate tax. Huge advantages there. But the active partners have to pay that full self-employment tax on their earnings.
The SE tax burden is the flip side.
So the provocative question is, does really thinking hard about the potential future tax cost or the tax benefit at the end of your business's life when you sell or liquidate or maybe pass it on, does that change how attractive a particular structure feels today? That S-Corp SE tax saving might look amazing right now, but if you're building a business with assets you expect to appreciate massively, does the potentially eye-watering tax cost of getting those assets out of a corporate structure down the road give you pause?
It absolutely should. Planning for the full life cycle, including the eventual exit, is really key to making the most informed entity choice right at the beginning. The long-term consequences can easily outweigh short-term benefits if you're not careful.
A really crucial perspective. Well, thank you again for sharing the sources that allowed us to dive this deep into such a complex but vital topic.
My pleasure. Hope it helps clarify things.